Hello and welcome again to another edition of Smart Money, a program where we are helping you to invest like a pro. It's brought to you by Vincent Capital. My name is RANGA MAKWATA. The last two recordings, we were looking at the mechanics of the market, the basic things that you need to know about the market and the securities which are there. In today's segment, we are going to talk about the human element in investing. So what are we saying? We are saying as an investor, or before you invest, you have to know yourself, understand yourself. That will then help you to choose the various options that are there for you as an investor. So we are saying self-appraisal is very, very important. There are so many different kinds of investors that are participating on the market, and all of them have got different success rates. But I think the most, with the exception of one kind of investor, the undisciplined investor. So you need discipline if you are to participate on the market. You need to have a strategy and make sure you are adhering to your strategy. You have to assess your abilities, do an honest self-investigation of yourself before you commit your finances to investing. So there are a few guidelines that I just want to share with you that you need to know to have at the back of your mind as you are embarking on the journey to be an investor. So one of them, or the first one, is age. So investing is also dependent on your age. So if you are younger, you can take more risk. Why? Because if you make losses, or if you encounter some losses in your youth, you are able to make some adjustments and recover. But as you are getting older, you need to be more risk averse, because you are theoretically left with a shorter portion of your life, and you don't want the heart attacks or the troubles of losing money and the pain of losing your investment at a time when you're supposed to be retiring. So age is important. When you are younger, you can take more risk. When you're a bit older, you have to take less risk. Also, you have to assess the availability or the funds that you have, and the needs that you have for your funds. So for someone who has got a lump sum, some money that they can commit for a long time, and they don't want to access this money for a day-to-day use, you can take an aggressive approach. Aggressive in the sense that you can even dive into more risk areas. But if you are starting off and you are having small amounts and you may have to resort to them for personal use, I think it's important for you to start investing in a less aggressive way. Be cautious, be conservative in the way you do your things. Then time is also important. So we are talking about the time that you can allocate to market issues. So you need to be someone that has got time to look at the market, research the market, and commit yourself to the market. So if you are someone that is constrained when it comes to issues of time, again, take a conservative approach. But if you've got all the time in the world and you think you can commit yourself more on investment issues, then obviously you need to go for a more aggressive kind of investing options. Then knowledge. They say knowledge is power. It also applies here. So when you're actually trading on the markets, when you're investing, you're actually buying into some stories. The story could be this company is expected to do well in the next months, years, or maybe there is some development that is coming from their research and development, a new product, a new service. So you're actually buying into a story. So it means you need to have access to the information. So it's very, very important. Make sure the intermediaries that you are interacting with are providing you the right kind of information, whether you're dealing through a broker or you're dealing through an asset manager. Then obviously your own aptitudes. People are different. I'm sure I remember the old game in the back in the day, the man or box game. So for those that may not be in the know, there was an opportunity for you to take a bet on a box whose contents you didn't know, or maybe get an assured sum of money. So it could be, do you want $100 or a box? And it depends with your risk tolerance and your views about life, and even your nature to gamble. So someone who is given to gambling is likely to go for a box because they're saying there could be something bigger. So when you're taking a box, you're saying, of course, there's $100, but there is a chance that I might get more than that. So it also applies to the investors as well. So if you are worried about losing money or losing whatever gains that you would have achieved, then you have to go for the conservative kind of approach. But if you think that you are comfortable with taking more risk, then obviously you have to go with more risk kind of investment. Then another element to this understanding yourself, or the human element to investing, is also assessing your financial position. So if you are financially sound, you are in a position to venture into some more aggressive investment spectrum. So these are some of the issues that you need to assess for you to really evaluate your financial position. Your debt. So if you are in debt, you are heavily borrowed. So it means you actually have got carrying some financial risk. You may need to be less aggressive, because if something goes wrong, then you are in trouble. Also look at your balance sheet, your assets. Do you have a strong balance sheet? Do you have some assets? Assets are important because they are, besides giving you the fallback, they can actually help you to even access financial markets, borrow, so that you can add to your investment, which you call leveraging your position. Then whether you're employed or you are earning some income, or you run a business, or that kind of thing, the importance there is if you've got some other source of income, or you are employed, so you know on a regular period you are getting some income, it means you can be able to take more risk, because if things don't go well, you can resort to your income for survival. So that aspect is also important. Then whether or not you have got some retirement plan, it could be an annuity or some pension schemes, that could also determine your level of involvement on the market. And then maybe last but not least, some assurances, whether it's medical aid or risk assurances, that will cover you if something goes wrong. So it's important to understand this about yourself. I think for today, this is what we wanted to talk about. So remember to like our Facebook page on Vincent Capital. Also subscribe to our YouTube channel if you want to hear more of this. And thank you for listening. Remember, at Vincent, we are creating wealth together. Goodbye.